Difference between shares, bonds and derivatives. Explain. Shares, bonds, and derivatives are different asset classes with varied risk-return profiles. While you may be somewhat familiar with shares and bonds, little is written about derivatives, which are considered high risk. Stocks and bonds are also a means of raising finance for any company. However, derivatives are assets that derive their value from their underlying asset. What are stocks, and how do they work? Equity shares give the holder of the instrument a portion of the ownership of the firm. There are other types of shares called preference shares, which offer a fixed dividend. Their dividend payment takes priority over the dividend payment of ordinary shareholders. Ordinary or equity shares can be either public or private. If the company takes the public offer route, IPO, FPO, then the shares are traded on the exchange, where the demand-supply dynamics would determine the share price. What are bonds, and how do they work? Bonds are fixed income securities that reflect loans made to borrowers by investors, typically corporate or governmental. A bond may be compared to an agreement outlining the terms of the loan and the associated payments between the lender and borrower. Bondholders, when compared to shareholders, are in a better spot if the business declares bankruptcy. They are paid back before shareholders, since they are included in the category of creditors. In addition, there is frequently a potential for recovery even when the issuer fails on its debts, although at a lower level. What are derivatives, and how do they work? Derivatives can be understood as a security with a price that is based on or derived from one or more underlying assets is referred to as a derivative. Changes in the underlying asset's value affect its value. The fundamental idea behind using derivative contracts is to make money by making predictions about how much the underlying asset will be worth in the future. Tips for beginners to invest in shares, bonds, and derivatives. Bonds are a safe place to start if you are a conservative investor. It is also ideal for adding some debt exposure to your portfolio to insulate against extreme conditions in the equity, derivative markets. Government bonds are safer than corporate bonds. Bonds have ratings. Look out for AAA or RR+ ratings, which offer decent returns at lower default risk. Start investing in equity shares only after a thorough understanding of the risk-return dynamics. Within equity shares, you have different categories of shares based on their market cap, which offers varied potential for returns and, correspondingly, their risk varies. You can also initially gain exposure to equity shares via mutual funds. They are professionally managed. They offer good returns and optimal diversification. To further curtail your downside, you can use the systematic investment route, which will further reduce your risk given the benefit of rupee cost averaging. Derivatives are of a very high risk cadre. It is recommended that, as a beginner, you stay out of this arena.